Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you a fixed period annuity and explain that for dummies. So I don't wish to offend anybody there. But essentially, what is a fixed period annuity? How can it potentially be beneficial for you, and how to make sure that you're avoiding the negatives at all times? And that's with all sorts of either investment contracts, retirement contracts, annuity contracts, and in particular, if it's not going to pertain for your specific situation, then obviously you should not be going into these types of products. With a fixed period annuity, this could be set up a couple different ways. You have either the fixed option, the variable option, or the indexed rate option. If you have a fixed period fixed annuity, typically this is known as a MIGA, which is known as a multi-year guaranteed annuity. This could be equivalent to thinking about how a bank CD works. What happens is an individual will go place dollars into a bank known as a certificate of deposit for a set duration of time. If we use an example of like a 5-year type bank CD, what's going to happen is each and every year there's a fixed percentage rate that's going to be paid out based upon whatever the principal was that you placed in there. If someone uses $100,000 and they purchase a 5-year bank CD that's paying 2%, well, then they understand after the first year they would have gained $2,000 of additional interest. The second year, $2,000, the third year, $2,000, fourth year, $2,000, fifth year, $2,000. So now they have $2,000 multiplied by those 5 years of essentially $10,000 worth of interest payments that was set up on a fixed percentage rate. At the end of those 5 years, they could then take their principal and either purchase a new bank CD or purchase it or walk away with that money altogether. So that same sort of concept is sold through an annuity, and it has to be sold through an insurance company because insurance companies are the only ones that can offer annuities. So for that fixed period of time, what it says is a multi-year guaranteed annuities, each year is going to have a fixed percentage rate that's guaranteed. This is where a big problem lies because individuals would say, okay, I'm going to have a 5-year fixed annuity, and they might be given 3% the first year, but then there's certain terms within that type of contract that says, based upon the discretion of the company, we could lower this rate down to a minimum of 1% every other year. So that's a horrible product. Simply put, what the company's trying to do is lock you into a product and then say, okay, we're going to give you 3% the first year, and then you're now going to be placed with this measly rate of return for the remaining 4 years. So when you're looking at the best types of the fixed MIGA, fixed period annuities, you want to make sure that it's just going to give you a level interest rate year by year by year. So the reason why individuals go into a MIGA product over a bank CD is because typically it's going to give you about 2 to 3 times higher interest rate, higher rates of return than what a bank CD will perform. But a bank cannot offer an annuity, just like an insurance company cannot offer a certificate of deposit. It's two completely separate entities, and both of those entities have their own slew of a legal reserve structure in place. The next example is going to be through a variable annuity. Once again, an insurance company is the only types of institutions that could offer an annuity contract. So what it's doing is a lot of times people associate annuity with income, with max income, and they're throwing dollars into an annuity product just solely for the income play, and that's not necessarily always the case. And especially after the 90s, 2000s, mid-2000s, and more recent years, there are certain hybrid type aspects that you could attach with certain annuity contracts that provide a lot more benefits than how just a generic type of annuity works. So with a variable annuity, understand this word variable means that that interest credit that you're receiving is either going to be a positive interest credit or it could have a negative impact on your principal. So that's why the variable annuities have gotten a lot of heat in recent years, is because you have very expensive mutual funds and very expensive fees in those types of accounts or related to those types of accounts. But once again, understand for the fixed period, if you have a fixed period MIGA for 5 years, that means after the 5th year, you could then have full access to those monies. With a variable, let's say if you have a 7-year product, meaning a 7-year fixed period for that variable annuity, that means after 7 years, then you could have full access to that money to then roll over into the next thing. So just understand, though, that there's a specific negative, or there's a specific risk with the variable of saying if you go and you throw your money into that type of product, it's not going to work as favorable, or typically does not work as favorable as just going into regular brokerage accounts, because the fees are weighing down the growth potential with those types of accounts. Now, there might be certain aspects, certain benefits, certain goals that are being met or trying to be met with variable annuities that you might want to attach an income rider to it or a death benefit rider calculator to it. But all that does is it's going to add on some additional fees. But that is the times that I've seen variable annuities work successfully, is obviously whenever it pertains to the goals. So just understand what the pros and cons are. The major con is the fees, and then essentially your entire account value could go down to zero with any sorts of variable accounts. So I hope that that makes sense. And the third and final option that someone could use is an index rate annuity, which is known as a fixed index annuity. So it has to go by certain legal reserve structures like how a fixed annuity works. But simply put, kind of like that bank CD route or example, or that fixed annuity MIGA example of saying if someone utilized $100,000, we understand with a MIGA, with a fixed annuity, maybe they're getting paid 3% per year, that it's getting 3% on 3% on 3%. With the index route, it says based upon a stock market index that that company is offering, they might give you like an S&P 500, a Dow Jones Industrial, they might have a Barclays index, whatever the case may be. This might be like a 7-year product, and after each year, it says your interest credit is determined is based upon whether or not that specific index went up. So if it went up, you might have a gain of, let's say, 10% into your account or 5% into your account. The next year, if the index goes down, well, then you have 0% gain into your account. So this just allows individuals to try to keep pace with inflation and try to gain into their accounts and have substantial gains into their accounts whenever the market goes up, but also have that protection whenever the market goes down. The negatives regarding the index annuities is when someone's trying to look for max growth. If someone doesn't really care about that safety aspect of that 0% floor, and they just really want to let it ride and say, you know what, I want to throw it into mutual funds, I want to throw it into brokerage accounts, I want to just try to gain as much growth as possible, then an index annuity is going to be hindered with that sort of goal, is because you have certain cap limits, you have certain spread limits that, yes, you're going to receive a gain whenever the market goes up, but instead of the full gain that the index would do, it might cap you at 10% or 15% or 7% or 5%, whatever the case may be. So this is mainly meant for the individual that likes to have that safe consistency and wants to try to have leverage a way to beat out those fixed percentage rates. Now, because of what's happened with obviously the economic deficit, we have interest rates have hit all-time lows. We have fixed accounts are very, very low, just like bank CDs are paying very small rates of return. Fixed annuities and MIGAs are paying low rates of return as well. But individuals still leverage MIGAs in the fixed period fixed annuities is because they just want to have that peace of mind that they're gaining something. Same thing with the index. It's going to play with that same sort of mindset. The variable is going to be more of that variable, more of that risky mindset. So just try to break down these things in a simplistic manner and make sure that you're avoiding the negatives at all costs. And customization is key. That's one of the things you have to really get away. You have to take away from each video that I try to explain to you guys and try to educate you guys is customization is key. You guys control the chips at every aspect of retirement. And what do I mean by that? What happens is you have these carriers. You have hundreds of different carriers, and each carrier has their own nuance, their own specifications on what products that they offer. So if you have hundreds of different companies, and then each company, let's say, offers 3 to 5 different types of product lines, there's no guarantee that that one's going to be the best one for your specific situation. You want to make sure that if you're 62 years old and you're looking to, retire at age 67, well, then there's going to be perfect offers for your exact situation. Or maybe in your 50s and you don't want to retire until another 15 years, well, then you want to go for a longer term type annuity, because the longer that you go and you place your money into these types of contracts, the more beneficial it typically is for your circumstance, because that's typically the higher guarantee that the insurance company could give you through the form of that annuity, and it makes sense because it's still placing you after that 59.5 rule. So what we do here at Afasi Financial Group is we have affiliations with every carrier out there in your particular area. So whenever someone calls in and say, okay, I might be interested in annuity, these are some of my goals, we're going to educate you first and foremost and see whether or not annuity is correct for you. If it is correct, then we go through something known as the Retire Sharp planning system that allows us to go through over 1,200 different products, strategies, and companies before giving you the top 3 recommendations on what might work best for your situation. From there, we're going to explain the pros and cons of each and which one would correlate best for your goals. But rather than just trying to cherry pick and say, oh, I saw a good advertisement, I just want to go with that company, you want to make sure that you could leverage the smallest amount of dollars possible with the most amount of benefit. And that's something that we try to do, is just make sure that you're controlling the chips, that you're leveraging these companies the best way possible, so if it's going to work out for your retirement dollars whether that's a growth goal, a max income goal, whatever the case may be. And we are A plus rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. And it's because we do this methodical process with our education and the way that we try to treat, any client, anybody that's calling into the office. So at any point in time, feel free to give us a call. We have 24/7 customer service, and give us a call at 1-800-566-1002. Once again, my name is Derek Afasi. I'm the owner of Afasi Financial Group, and I want to thank you very much for watching this video, and make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.